Hey guys, welcome back to the channel. So as you know, I'm a big fan of passively managed ETFs. That's because generally speaking, it's really hard to predict which actively managed funds will do well or outperform the market. And most of the time, active managers don't outperform the S&P 500. And generally speaking, the fees charged by active funds is much higher than the fees charged by passively managed funds. That's just because there are actual active managers who have to stock select. And so you're basically paying for their work. That said, I'm not on principle opposed to active management. I think there is a time and a place for that. I think active management becomes really helpful when markets are uncertain or volatile, or there's, a lack of clarity or information in the market. And so using active management can be a strategy to help minimize volatility or increase gains. I wanted to do a video on active management by looking at Vanguard's 5 actively managed ETFs. I thought it would be a good chance to just look at what they're doing. Their actively managed ETFs are still fairly low cost compared to other actively managed accounts. So I think because they're fairly cheap and because they invest in a lot of stocks that you would see across many of the passively managed accounts, you know, there may be less risk to paying a little more for these actively managed accounts. And at the end of the day, I think what's really important is that you just keep investing in the market. And if you can use them strategically, I think they can help your portfolio. I'll start by sort of showing the returns for the last year for these 5 actively managed ETFs. And so as you'll see, only one of them has outperformed the S&P 500 in the last year, and that's the Vanguard US Momentum Factor ETF. Now, this makes sense because we have been in a momentum market. Stocks that have been growing have continued to grow. And so investors have been just piling into those stocks. And that's what the US Momentum Factor does. It looks at stocks that have strong recent performance. And so, yeah, we're looking at stocks. Again, their holdings are stocks that you've heard of with explosive growth recently. So their top holdings are Palantir, KKR, Boston Scientific Corp, NVIDIA, General Electric, AppLovin Corp, AT&T. So these are stocks that have had strong momentum in the last year. And so there's a decent amount of turnover in the portfolio. There's about 73%, it says. And so this is fairly actively managed. Turnover rate for passively managed accounts is much lower, probably some sub 20%, sub 10% a lot of times. And so, if we're thinking of the market as sort of continuing on the trend of momentum, this might be a good fund to invest in at the moment. Though it's up a lot, if the market continues to move in that direction, you'll still continue to see that growth. The next fund is actually the most expensive of the 5 actively managed ETFs. It's 18 basis points, but it's Vanguard US Multifactor ETF. So again, this is a quantitative ETF, basically trying to remove the most volatile stocks. And so according to, the description, it looks at momentum stocks that exhibit strong recent performance, quality stocks that exhibit strong fundamentals, and value stocks with low prices relative to fundamentals. So again, the multi-factor part of it is that it is investing in 3 different areas, both strong performance, high quality stocks, and then value-oriented stocks. So it's broad. And again, when we look at the holdings in here, we can see that it's a lot of mega cap stocks, stocks that we've heard of. Right now, it seems to have a strong financials holding. It's, their top holdings are Wells Fargo, Bank of New York Mellon, Aflac, Philip Morris, Altria, American Express. Again, really big companies that you've heard of. And here, though, compared to the momentum fund, the turnover is a little bit lower, For the last year, it's about 40%. So, you know, actively managed, but, you know, because they're looking at quality and value, they'll probably hold stocks for longer. This will give you some amount of protection, probably in a downturn. So this is a fairly broad ETF, and it holds about 500 stocks. So the next one on the list is Vanguard's US Quality Factor ETF. And this has the same expense ratio as the Momentum. All the rest of them actually do have the same expense ratio. This obviously hasn't done as well as the Momentum Fund because it invests in stocks with strong fundamentals, which just means it's going to favor value stocks over growth stocks. And here the turnover rate is higher than the Multifactor ETF at 55%, but still lower than the Momentum ETF. And so, yeah, we'll see that they have the holdings here are Gilead Sciences, Kimberly-Clark Corp, Nike, Apple, 3M, Target, Walmart. So they're investing in, you know, a broad range of sectors. And the fund is, you know, underperformed its benchmark, likely because, you know, we've been in a growth market. And when you're looking at strong fundamentals, you're probably not going to keep up with high growth stocks. But, you know, the Quality Factor ETF might be a good addition to a portfolio if you want to become more defensive. The next ETF is Vanguard's US Minimum Volatility ETF. And this fund invests in stocks that have lower volatility, as the name of the fund suggests. Again, it uses a quantitative model to determine this. As with the other sort of quality-based ETFs, it's underperformed the benchmark. And again, that makes sense because it's not favoring growth or momentum. The turnover here is not super high, but higher than index funds at 26%. And it's investing in large companies as well. I think some of the names that are more familiar to us are Procter & Gamble, T-Mobile, AT&T. We can see by sector that it heavily invests in technology and healthcare. But it's also important to note that technology has become a huge part of every single ETF because of how much it's grown in the last year. So just as these technology stocks have become bigger and bigger, they also become a bigger portion of the index funds that they're in. Again, the US Minimum Volatility ETF is probably going to have lower highs and higher lows. So you're basically just shaving off some of the volatility that you're going to get in the markets. You know, this could be a nice addition to your portfolio if you're looking for some more steady growth. If we see the markets pull back, this fund will likely pull back by less. Finally, let's look at the Vanguard US Value ETF. This is also a sort of defensive ETF. It's looking at stocks with lower market valuations relative to fundamentals. So again, it's looking at stocks that seem like good deals. When we're looking at a lot of these tech stocks that have grown over the past year, their valuations probably seem very high comparatively. But again, in a momentum-driven market, that's not a bad thing. They're going to continue to grow. So, you know, the turnover rate here is fairly low at 24%. And it invests in, you know, sort of like a lot of financials and industrials and some consumer discretionary. Some of the stocks that are held are Altria, AT&T, FedEx, General Motors, Bank of America, ExxonMobil. Again, you're getting really, really big companies. This is a very value-oriented ETF. And you'll probably see a lot of these same stocks in your S&P 500 index fund as well. It's hard to say when these actively managed funds will outperform their benchmarks. In the past couple of years, they really haven't, because we've been in such a momentum-driven market, and because we're in such a high-growth market. But, you know, as markets pull back, there may be some value to having some active management in your portfolio. That's not to say that you should sell any of your index funds. It's just as you begin to place more money into the market, you may want to consider adding some more value-oriented stocks to your portfolio. Just to recap, I'm not philosophically opposed to active management. The two reasons that I tend to recommend passive management over active management is just that active management rarely outperforms passive management, and active management has higher fees, which ultimately just eat away at your performance. So all in all, if you're looking for the simplest strategy, I would just continue to invest in passively managed ETFs. But if you're looking for a bit more active management on your own end, you may want to select a few ETFs. And Vanguard has fairly low expense ratios on these ETFs. So I would say the risk of losing out is lower than if you were paying sort of higher expense fees on other ETFs. Anyway, I hope this was helpful. It's just an introduction into Vanguard's actively managed ETFs, and I hope it gives you just a broad view of what's out there.